Yes, active versus passive.
Yeah.
There's a variety of different considerations. Um, Generally, what the larger, I was talking about the fee pressures and some of the pressures on individuals. You're asking how that changed, but the size of the market is increasing, and the complexity of the market is increasing, and the correlations of bonds go up and stocks go down, that's not really working anymore. So what the larger institutions are doing, again, us looking at the larger institutions and learning from them, is they're employing things like alternatives. And alternatives are might be examples where you get enhanced yield, or you can employ margin in certain ways, or you have long short market neutral, or you have access to different kinds of strategies. A very popular strategy now has been looking at private markets, and sometimes you can access this through alternative investment.
Interesting.
And institutions can do this because they do it, with large hedge funds and pools, but it's really not that available
The
to
retail.
individuals. Yeah, which is something that we're working on providing. And you might say, okay, well, what's the big deal about private markets? Well, think about this, Jeff. If you have central banks all over the world that are, first of all, they're printing money, and okay, we couldn't get inflation for a long time. Everyone was fussing at the banks because they couldn't make inflation. I don't know if you recall that, but it was only a handful of years ago. Now all of a sudden they're making too much inflation, so it always kind of swings around. But when all this money has gone into public markets, what's the essence of what they're trying to do? They're trying to incentivize risking, like risky behavior. Not risky behavior. They're trying to incentivize behavior of reaching for more risk, investing more in the market, and so on. Does that make sense?
Because of the inflation is going up, hence the return. Is that what you mean a
No,
differential or?
no. So when the central bank, when they stimulate the market and when they
Yeah.
print money, what they're trying to do is, because they're trying to do that because the market has slowed down, right?
Ah, got it. Stimulate growth.
Stimulate growth. That's why they're doing it. I
Got
mean,
it.
it's not because, like, hey, dude, let's go to the club and let's, print
Let's
a
go.
bunch of money. Yeah, they're trying to
Got it.
stimulate. So what's the mechanism in which they stimulate growth? Well, there's more money out there. Well, there's two ways. One, you lower interest rates, so you're not going to make any money by keeping it in the bank. Might as well go invest it.
You've got to
But
go up the risk curve.
what about when you already get to that zero bound? What do you do then? Do you do negative rates? Well, they did in Europe.
I thought New
What do
Zealand
you
was
do
talking
then?
about it as well. Yeah. What
Yeah.
do you do then? Yeah. What do you do then?
Well, what they did, quantitative easing, QE. So you increase the money supply. And for a long time, that did not increase inflation. And the reason why was because banks were hoarding it and boosting the reserves, and they weren't really lending it out. So then you have the notion of non-bank lending, which is asset managers and so on. I'll get to that, but that's the private market. So the bottom line is, all this money is being printed, right? And they're trying to stimulate the market, and that didn't quite work, because the banks were saving money. We're saving that money, and then what happened is, what you want to do ideally is you want to get this money in the hands of investors, so that they'll go out and they will invest in new projects and new growth projects and new capital spending projects, and the economy will grow again.
Increase the pie.
Increase the pie, but in the sense of that you have to spend money to make money, or let's just say you want people to come to Sydney, and you want them to come stay in a hotel, come to a convention center, and do some conferences, and maybe work in a corporate office there, or build a factory. You need to have money to build those
To build it
buildings.
up.
Right. So you need people to want to take that risk. The way it works in a capitalist society, if you work in a communist society, the central government says, hey, we need a building here. You people go build it. It's said, it's done. The way it works in capitalist society is they say, all right, we assume that you're looking for a return. You're looking for a return. This will be a good
Yeah.
return for
If
you.
we lower the cost of borrowing for you, right, you're more likely to create that factory.
Right, 100%. So that's the
You're gonna
basic
hire
essence.
you're gonna hire people. You're gonna create jobs.
Yes.
From an economic growth point of view, you're increasing the pie. There's more jobs. People are happier. We achieve full employment. Wages go up. Happy days, so to speak.
Right. And then how does that get paid back? Well, when there's more jobs and there's more taxes, then that taxes come in. And that's called
That's
the invisible hand of government, that kind of thing.
interesting.
So what happens is, that's generally how that kind of thing is supposed to work. So what happened is, post-COVID and, a couple other instances, governments went in and they were buying direct securities. In the US, for the first time ever, the Fed went in and usually how they'll do their money market operations will be through buying treasuries and, government related securities, but they went and bought corporate securities. And Europe had been doing this for a while too. So this is really important, Jeff. And the meaning of this is, and the government will come in and they'll buy. Think about this as like a continuum of how risky it is. The government is the least risky. And then like really large corporations are, just a little bit more risky. And then smaller risky corporations are even more risky, et cetera.
And then
then
it goes up.
It goes up. So like, for instance, when the government, they buy the treasuries or, the government securities, then they start buying the investment grade companies. And then they start buying, for instance, some of the high yield companies. So what happens is when the government comes in and starts buying, and this happened in Europe as well, specifically with their investment grade high yield market, when the government comes in and starts buying, they crowd out private investors.
Interesting.
And then so these private investors that get crowded out, they go into, actually, I'm going to use these terms, and it's they're used interchangeably, but it can be confusing. When I say public, when I say private investors, I mean not the government investors, like regular individual, non-government employees, private in that regard. And they go in and they'll, and the government will buy stocks or bonds. But then, because the government has gone into, and I'm going to use these terms differently now, has gone into the public markets, which includes stocks and all this kind of stuff, and has really crowded it.
Yep.
And or lending markets, and so on, the more public lending markets. Then what do these non-bank lenders do? These asset managers, they start lending in the private markets. So the kind of the real economy, direct lending, private credit, all these type things, small businesses, and all these type lending. So what happens is, it's interesting how you have these large macroeconomic, stimulus type things. The government comes in, it pushes out, it crowds out a lot of private investors, and then where do they go? Then they kind of go into the real economy. So I guess that was a bit long-winded, but some of those aspects of credit, they're part of what's called alternative investments. So it's an alternative to your 60% public stocks and your 40% public bonds. There's like alternative ways of getting these yields. And one of the things I like to do is think about, if you want to get a 5% return, Jeff, how can you do it? Okay, well, you can buy a government bond with a heck of a lot of leverage, but if rates go up, your duration, well, I won't get too in the weeds, but you have a lot of duration sensitivity there. You could maybe buy a high yield bond. You could maybe buy a stock with a dividend. You could buy commercial real estate.
To achieve that 5% return.
Yeah, depending on what it is. I mean, maybe you couldn't do Class A multifamily now, but maybe you could do something, industrial. You could buy timberland, and for instance, timberland. Yeah. So for instance, if you think about it, that's almost like a bond too. Because what is a bond? You buy something, you get periodic
coupon
payments or coupon back, and then you get your principal back. So what happens when you buy land? That's timber, like specifically growing trees.
Interesting.
You pay it out, then you receive your interest, which is the harvest, and then ultimately you can sell the land.
Hence, it's just like a bond.
It's like a fixed income instrument, and you think about it that way. Agriculture can be that way too. But you say, oh, what's its duration? So for instance, when you cut trees, actually where I grew up is they have timberland. I was really getting involved in this. And
yep.
Anyway, so whoops, I think I lost you. Anyway, so
Yeah, no, I can still see it.
They that cycle might be every 7 years you do a trim, or every 15 years. For instance, if you buy an apple orchard, I don't know this off the top of my head, but maybe that cycle is every 3 years. You buy, so
And
there, it's
that's the duration
interesting.
sensitivity. Is that correct, Robert?
No,
Or
that's, well, for like an apple, it's whenever they do the harvest, because
interesting.
what you're thinking about is how you're going to get paid. You're just thinking about cash flow streams, what you pay for the asset, and then when you get cash flows coming back to you, which could be coupon, it could be dividend, it could be rental payments from multifamily, it could be the selling of apples for the harvest. So I'm not trying to be too obscure, but if you kind of take a step back and think about things in a kind of a relative value way, you can think about, I want to get a 5 or 6% return. Where are the best ways that I can do that? And so that's like a larger example of how you can holistically think about, I find some
Interesting.
people say, oh, I can only get a 2% return because 10-year treasuries. I'm like, well, there are other ways. There are
And that's
alternative
the
ways.
and that's the
Yeah.
alternatives. Is that correct?
Yeah. I mean, that's an example of
Interesting.
alternatives.
Interesting.
Like one example of alternatives is real assets. Some is real estate. I found some really interesting structures where you can get double-digit cash flow returns by buying certain properties in certain regions, and then with some of the vacation rental income.
So that is the real economy, like what
Yeah,
you
the real
said.
economy. And so it's
Interesting.
interesting. So I guess we're coming a little bit full circle, but part of me was spent so much time on Wall Street, got out in the real economy. One, people need help. Two, I feel better, in some ways connecting and helping with people that you can meet and see and work with. Sometimes institutions are quite big. I did love that work, but I
Mm,
really love getting out in the real economy and working with people. And I'm finding increasingly, as you're empathetic and you talk to people and are trustworthy, they really open up. And I'm finding all these incredible ideas, like for instance, some related to small businesses and restaurants with cash flow that are looking to do some land related transactions. Others, for instance, you might have someone that, and in those ways you can also combine insurance. When you combine insurance, a lot of people think about that as protecting your life, but you also can get guaranteed income through some of these policies, and it's tax free. So there's lots of
interesting.
little interesting
Interesting.
kind of tricks. So you might say, all right, well, we talked about a lot. Well, now how would you do something like that? Well, would you like to have a little bit of guaranteed tax-free income? Call it, 4 or 5%, something like that. Maybe you want to have a chance for some decent upside. So maybe you want to put just a little bit into crypto, like a Bitcoin or Ethereum, something along that line. Call it digital inflation. You broadly probably need to be in stocks. I mean, because and so of course I agree with ETFs, and how they'll do that is maybe 50% or 60% of your portfolio still is traditional, with stocks and bonds. But do you want to be in S&P? Do you want to be in the Russell 2000 in the US, Europe? There's a lot of decisions in which ETFs you're allocated to. An interesting thing that I learned, Jeff, is a lot of the returns, people think it's like picking the greatest stocks, and you can have some home runs for sure, but it's really that top-down asset allocation. You got to be fishing in the right pond. If you buy the very best treasuries, or if you buy treasuries and when interest rates are going up, they're going down,
If the price goes down, inverse relationship.
yeah, that's right. That's right. So asset allocation, being in stocks in the years that, not everything goes up every year. Over time they do, but not everything
Oh
goes up
yeah,
every
no,
year.
Robert, the
If
market
you're able
always
to
goes
pick
up.
years they go up, and yeah, exactly.